Hello everyone. Today I'm going to expose a really common trading myth for you. And that is that, professional traders avoid the news. Now, whereas there are times when it is appropriate to avoid the news, actually news trading can provide you with some fantastic trading opportunities. So I'm going to show you from my own trading a couple of examples. And also throughout this course, I'm going to illustrate what I'm explaining with real life trading examples. So you can see that this is not just a theoretical principle, but it's something that's actually done in real world application. So I'm going to look at two examples during this presentation. So I hope that serves to illustrate the point. But without further ado, let's get stuck into the session. Now, many sort of trading gurus, particularly on the internet, will say retail traders, you've just got to avoid big news events. And whereas there are times to avoid big news events, there are definitely times when news events are fantastic opportunities. And oftentimes they'll say there's too much volatility. And then sometimes people say it's impossible to predict direction. You get good data and it moves down, you get bad data, it moves up. It's too difficult, it's too complicated to understand. The problem is those claims are flawed because volatility, right, is only bad if it's unwanted and you're positioned on the wrong side. Volatility in your favor is tremendously advantageous. And secondly, reactions aren't always unpredictable. With the right framework, and what I'm going to be doing in this course is to show you how you can anticipate market moves with high confidence. I was looking back through my 2024 news trading results, and there was virtually, I think there was only a couple of losers out the whole year where the analysis was wrong. So there was getting that edge was just so clearly in the data. It was really nice to see. That's for 2024, just before making this video, and I'm here in 2025, and I'll show you a couple of trades from that 2024 year. Now, one of the hardest things for being a retail trader is that you don't have that institutional edge. But you see, professionals, what they will do is they will seek volatility because it does create those strong directional moves. It brings liquidity, it brings cleaner structure, and it can help confirm a fundamental view. If you have a news data that's released and you see a strong move in a particular direction, you know that you're likely to have a lot of orders backing up that move, and that fundamental view that you've had is being sort of confirmed by market dynamics. Don't worry if this seems a bit complicated at first, it will become clear. And the actual process for recognizing these tradable opportunities is only 3-step, and it's so simple that once you've learned it, you can easily remember it. Now, timing can be very difficult with trading, and even with a strong fundamental bias, price can still drift against you. And that is the weakness of fundamental trading, is that you might fundamentally expect a currency to go one way, but if it goes against you, how far will it go against you? Now, what risk events can do, they can act as catalysts for the fundamental move to reassert itself. So it can allow you to time your entries when volatility lines up with your view, particularly when you've got a strong bias and then the data is supporting that bias. It can really help you. Now, let me give you an example from my own trading. Now, in this example, the Swiss National Bank had an intense focus on inflation. Now, in particular, they were looking at rent prices, but just prior to this CPI inflation release, I'm going to show you the detail in a moment. So in a moment, we're going to watch that video, which is a record that was done at the time for the Swiss inflation print. But I want you to notice, before you look at the video, that Swiss inflation was in particular focus with the Swiss National Bank, and the then chairman had said that he was concerned about the strength in the Swiss franc. So the Swiss is a strong export economy, So a strong Swiss franc is problematic for the Swiss because it means their exports become more expensive. So the governor of the central bank was saying, look, we really want a weaker Swiss franc. And then with the inflation data coming out, we knew that if it was a weak inflation print, that would give the Swiss National Bank the excuse, if you like, that they would need to move towards interest rate cuts. Because they could say, oh, inflation's falling, we can cut interest rates and we can deal with that strong Swiss franc. So you're going to look here at a euro Swiss franc long that was lining up with the market sentiment, lining up with what the Swiss National Bank wanted to do. And you can see in this recording how the euro Swiss franc just moved in one direction very quickly and gave a great opportunity to get in on that trade in the euro Swiss franc. So do take a look at that trade from 2024 and I hope you enjoy it. On February the 13th, one key event we were looking at was the Swiss CPI print. The Swiss National Bank had already mentioned that they were concerned about the strength of the Swiss franc, so any significant falls in Swiss inflation was likely to see significant Swiss franc selling. So if we saw a big miss as we analysed the data ahead of the event, then we're expecting euro Swiss franc and dollar Swiss franc upside. Now, looking at the data point, you can see 1.3% was what we're looking for the year on year, minus 0.2% or lower for the month on month. Now, taking a look here, you can see that the data did come in below expectations, 1.3% tick. That was a sell Swiss franc bias. And the month on month data, it wasn't quite what we're looking for, but given the fact that it was towards the low end of expectations at 0.2%, that did give us a euro Swiss franc upside. We could have also taken a pound Swiss franc upside with that strong UK wage data out half an hour before. And you can see here was the trade, euro Swiss franc. You can see it moved very nicely in one direction immediately after the event. And a number of people took advantage of that euro Swiss franc miss in the Swiss inflation data that took place on February the 13th. So these are the kinds of high probability trading opportunities we're looking for on a daily basis. Okay, that's one example. And you can see in that example, there was clear directional bias for the euro Swiss franc. And you see how the volatility helped push up price in the direction. See, those risk events, they create clear tradable moments when you can expect a currency to be moving in one direction, likely to hit up to a next resistance level, maybe a key pivot point. Don't worry, we'll go into all these elements in more detail as we go through the course, but you can see, how that could have worked out because we've got that clear bias for euro Swiss franc upside, great opportunity. Another example is in the dollar CAD. This was a dollar CAD long in March 2024. Now you'll see here that we were looking for a miss in Canadian inflation data to give the Bank of Canada the green light to move towards interest rate cuts. At the same time, we had speculation regarding the Federal Reserve that they might be a bit higher for longer, a little bit more hawkish. So we had this big bias that we're expecting dollar strength, and then we're also looking for opportunities of CAD weakness. So we're looking to pair a strong currency against a weak currency. So in this example, just notice how the dollar CAD moved in those two different directions. With the dollar, there was broad pressure in the market for dollar strength, right? And when that was paired with a sudden reason for CAD weakness, it gave us that fundamental dollar CAD upside bias and just gave us that conviction to see the dollar CAD move higher. So here's another example from March 2024. I hope you enjoy it. So this week on March the 19th, we were looking at the Canadian CPI print. And what we wanted to see, there were two-way opportunities, but if we started to see CPI for Canada dropping lower, we expect to see some CAD weakness. And on the day, we were seeing some speculation before the Fed meeting that the Federal Reserve would be maybe more hawkish, that they might revise the dot plot showing less interest rate cuts coming this year. Dollar's been buying on that, also push higher in yields, and a disappointing Bank of Japan meeting allowing the yen to weaken again, pushing up dollar yen. So dollar strength was marked on the session, And we got a miss in the Canadian CPI as we covered this event live at 12:15. And as the data released, I saw that is suitable for shorting the CAD. Month on month, in line with the low. Year on year, in line with the low. Core below the prior 2.4%. The median, trim and common all below the prior, and a revision lower in the common from 3.4 to 3.3. That supports the idea of interest rate cuts from the Bank of Canada, and so we were likely to see weakness in the CAD, and dollar CAD long was the trade. We took a trade out of the decision, taking profit up at those highs, and then also looking at a potential re-entry around that 1.3587 region, 50% fib retracement level, and the cut across the top of that near-term resistance level, and stops can just run underneath that R2 level, looking for a potential bounce. Also looking for a high and tight flag pattern, which could give us a good breakout move, potentially later on in the session, with price of the dollar CAD right up at those highs on the day. And if we ended up going above those levels, then we're likely to see stops being tripped. So we've taken one opportunity, looking for a pullback opportunity, and this is why we look at the calendar and do our analysis in advance, looking for those high conviction tradable opportunities, and we see that came in very nicely today. A number of people in the community taking advantage of that. Pound CAD longs, dollar CAD longs, and short-term scalping with a potential re-entry of a high conviction move from that 1.3587 region. And that's why we look at the calendar ahead of time, so we can spot these high probability opportunities before they occur. So these principles can be applied across multiple asset classes. And if you know what to look for, you can find consistent opportunities that are repeatable with a specific process, right? But you have to be selective. You don't just trade every risk event. I'll show you in this course how to find out which risk events to look at and which ones to ignore. Some events do produce untradable volatility, and you have to be selective in the way that you enter these markets, often waiting for a pullback or making sure your risk is clearly defined. And you have to know when to step aside. So it's not like this is the holy grail of trading and that you can never have a losing trade. You've still got to manage your position. You've still got to make sure your stop and your risk tolerance is acceptable, and you still have to realize that not every single risk event is tradable. But with a tested process, some trades do have a very high directional probability, and with a little bit of practice, you will be able to pick this up. And I'm going to share with you a 3-step process to help identify these key setups, so you know exactly what to be looking for and exactly how to find those key data points. So as we sort of begin this course, don't fear news events, because if you are on top of your fundamental narratives, they're a goldmine of opportunity. And remember, a lot of professional traders love these news events. Trading out of them, you get some clear directional bias. You can get some great trades. But if you're just guessing, if you don't understand what's going on, then of course you would avoid risk events. And for some people, on the internet, they would maybe just prefer to focus on technicals. Okay, that is an approach. It's fine. But remember that if you can understand the fundamentals, then you can have the technicals and the fundamentals. And for me, why choose? Why choose technicals or fundamentals when you can have both? And the key, stop guessing and get yourself informed, prepare with the right process, and then all of a sudden you can have a potential goldmine of opportunity that can emerge. And every now and then you get some stunning fundamental trades where the market's expected to go in sort of one direction for sort of weeks and months. And by looking at the fundamental process, you can get hold of those kinds of trades as well as the intraday opportunities.
Don't fear economic news. Use it. Volatility isn't just chaos, it's opportunity in motion. With the right view and timing, risk events can give you the cleanest trades. Institutions love news events. They bring liquidity, clarity, and direction. You should too if you have a framework and a plan. Waiting for news to align with your bias gives you higher conviction and better timing. That's not gambling. That can be strategic positioning when done correctly.
Let's start this basic introduction to fundamental analysis by clearing up a very simple but common misconception. Fundamental analysis isn't just for economists or market veterans. It's something which I believe anyone can learn because it's actually based on something very, very familiar. And that's simply to determine whether something is worth the price it's being offered at. At the very heart of fundamental analysis, we're asking a value-based approach. What we're asking is, what is this asset really worth? And then we compare that to its market price. We might look at it and say, oh, it's undervalued, that's cheap, I want to buy it. Or we might look at the product and say it's overvalued, that's too expensive. Or we might think that's a fair price. And that is the very essence of fundamental analysis. Now, many retail traders tend to avoid fundamentals because in many instances they may be taught to avoid fundamental analysis. They might be told it's too complicated or it doesn't make sense. Or they might think, well, I need a deep economic background to even begin to understand fundamental analysis. However, once you break it down, it is actually far more intuitive than it seems at first sight. And to begin to introduce this topic to our minds, we apply the logic of fundamental analysis every day. Have you ever skipped, overpriced strawberries at the supermarket? Or maybe there's a particular spread or a product that you really like and then it's priced too expensive, so I won't buy it today. Or how about if you ever had, I'll have an extra hour of sleep today, that's better for me than going to the gym. Or I won't go to the gym at lunch today, I'll spend some time reading or relaxing. That's value-based decision making. And it's exactly the same principle that we apply in the markets. You see, in all these everyday situations, we're weighing what we give versus what we get, what we pay versus what we receive. That's all fundamental analysis is. Evaluating whether something gives us enough value to justify the cost. Now, when we apply this sort of thinking to financial markets, it means we're going to start assessing the value of assets based on economic data, monetary policy, and key economic drivers. So, if you're analysing the US bond market, for instance, you're looking at the Federal Reserve's policy stance and broader US macro trends. If you're looking at the UK bond market, you're looking at the Bank of England's policy stance. You see, you have a different way of assessing value, but it's the same principle that you use in the supermarket to decide whether the strawberry on offer were fairly priced, overpriced, or underpriced. Now, with FX markets, commodities, the equation is slightly more different. You're looking at supply shocks, global demand. For instance, if all of a sudden there's a great problem in Chile with the copper mines and a number of the big mines get shut down because of some accident, then all of a sudden you know that copper is not being produced, but demand remains the same, so price is likely to go up. Similarly, with global demand, if all of a sudden there's an increased demand for copper or for oil, you would expect oil prices to rise, copper prices to rise, because demand's expected to increase. Now, the FX market is more complicated, and it is one of the hardest markets to begin trading with. And part of the difficulty with FX markets is that you're really analyzing two economies at once. You see, currency pairs are just that. Currencies are traded in pairs. the euro against the euro against the pound, the dollar against the yen, the dollar against the Swiss franc. So for instance, right, say for instance you're trading the pound dollar, you're not just interested in what the US economy is doing and the US central bank, the Federal Reserve. You also need to understand what the Bank of England is doing and what their direction is and how the UK economy is doing. Because the only way to determine whether the pound dollar exchange rate is fairly valued is by having an understanding of what's going on with the US economy and with what's going on with the UK economy. So you need to know those two different factors. Now, don't worry, I'll show you how to do all this through the course. And it is made significantly easier because central banks communicate to the market what the particular focus is of theirs at any given time. And I'll show you in a numerous different ways throughout this course, through real life examples, through looking at the central bank's communications themselves. I'll show you where to get that from, and I'll show you how to put that into a very simple 3-step process. So the big picture, whether you're trading equities, bonds, commodities, your goal remains the same, right? You're trying to determine if the market price aligns with the asset's intrinsic value. And that analysis gives you a directional bias, or it tells you to stay out. So maybe think of your fundamental bias as a kind of gravity, right? That's kind of the underlying pressure. If there's no short-term news or events pulling price in the other direction, it tends to follow that path of least resistance, drifting in line with the fundamentals. For instance, if the dollar's expected to gain, over half a year, if there's nothing really influencing the dollar, in a particular time, you expect, on balance, you'd expect it to keep drifting higher and higher and higher. So think about it a bit like water flowing downhill, right? When water's coming downhill, it might bounce off a few rocks, it might take a few squiggly detours, it might turn to the left or to the right, but fundamentally, the general direction is always downward. And in markets, unless disrupted, price tends to move in line with the prevailing macro backdrop. Now, it doesn't move in straight lines. Markets don't move in straight lines. They tend to move in waves, and I'll show you how to understand that sort of wave-like action of the markets. But you will see this kind of big picture, playing out over and over again, that big macro stories, you tend to see the market moving in one broad direction, and that sort of water down a hill is not a bad visual way of thinking about it as we start to look at this subject in more detail. So don't overthink the fundamental analysis. Don't let the terms scare you. There are moving parts, there are details to know, and we will cover those details so you will understand how it all puts together. But at its core, at its very process, you already use fundamentals in daily life. And our job now is to apply it systematically to the markets. And I would say, don't forget, it is in the central bank's interest to communicate to the market effectively what's influencing their interest rate decisions. And it's ultimately the central bank's interest rate decisions, which is primarily moving currencies. And those banks do communicate clearly, and I'll also show you what data points they're focusing on and how to always see what key thing to look at. But remember, fundamental analysis is already part of your daily life. You just need to learn it to apply it to financial markets, and in particular into currency markets.
Fundamental analysis is just asking, is this asset worth the price? That's it. It's the same logic you use when skipping overpriced coffee in the supermarket. You already do this in real life. You weigh the cost versus the benefit. Now apply it to markets. Compare economic drivers to price action. If they match, great. If not, opportunity. In currencies, you're not analyzing one economy, you're comparing two. That's what makes FX both challenging and exciting.